Welcome to the deep dive. We're really glad you could join us today for the Golden State Real Estate Quest. If you're working your way through the world of California real estate, maybe you're studying for the license exam, a student, or, even a seasoned pro looking for a good refresher. It's complex. We've looked at the basics, property rights agency, but
Today we're tackling what you might call grand orchestration, the precision landing of it all, escrow and closing.
Exactly. This is really where everything comes together. All the planning, the negotiating, the checks and balances.
It's where that signed contract turns into actual keys in hand.
That's right, yeah.
And the money changes hands officially.
Precisely. And, people sometimes think of it as just paperwork, but it's so much more than that. It's critical.
It really feels like the final exam for the whole transaction. Did everything get done right? That's a great way to put it. It demands serious attention to detail, a deep understanding of every step, getting that closing done smoothly, without hiccups. That really shows an agent's competence, their integrity, brings that harmony, that final peace of mind to the deal.
Okay, so let's dive in. Our goal here today is to take all these sources, guides, articles, notes, even some really useful insights from online discussions and pull out the essential information for you. We want to make this whole escrow and closing thing, which can seem pretty dense, really understandable, and highlight your role as the agent in guiding clients through it.
Absolutely. We'll start with the basics. What escrow is, why we need this neutral party. Then we'll walk through the whole process step by step from opening it up right to the very end, the closing. We'll break down the money side closing costs, how things like taxes get prorated with real precision. And then, importantly, we'll tackle the potential bumps in the road. Common challenges, things like fraud, which is a big one, and the ethical tightropes you might walk.
Sounds like a solid plan. Let's start right at square one. Buyer and seller have a deal. They've signed the purchase agreement. Now goes to escrow. So what exactly is escrow? Why do we need this neutral zone?
Think of it like a secure holding area, a temporary safe deposit box, but managed by someone totally impartial. Your sources consistently define it like that, a process where a neutral third party holds on to the crucial stuff, the money, the documents.
So like the buyer's deposit money.
Yep, the earnest money deposit goes in.
Right.
Later, the lender's loan funds, also the signed deed from the seller, all the disclosures, the legal paperwork, it all sits safely in escrow.
Okay, so the buyer doesn't just, write a check directly to the seller at the start.
Definitely not. And there's a really fundamental reason for that. It's all about protection. The whole point of using that neutral third party is to safeguard everyone involved. The buyer, the seller, the lender, sometimes even the agents themselves.
It builds trust, right?
It does. It creates security where there might not be any otherwise. I mean, think about it. Buyer and seller have just been negotiating, maybe intensely. One source put it really clearly. They might not fully trust each other to just hand over money and property simultaneously.
Yeah, who goes first?
Exactly. The chicken and egg problem. You need that impartial referee, the escrow holder, sometimes called a settlement agent or closing agent, to make sure all the conditions in the contract are met before the money moves and the title transfers.
Got it. The trusted middleman, essentially. And the person or company doing this is the escrow holder or escrow agent?
That's the one. They act as the representative of this neutral party. Their job is to follow the detailed instructions that the buyer and seller give them based on that purchase agreement they signed. Now, escrow is a concept used across the U.S., but how it's regulated, the specific rules, that can vary quite a bit from state to state.
Ah, perfect lead-in for our CA corner. How does California handle this? What makes it specific here?
Well, in California, if you're an independent escrow company, you have to be specifically licensed, and you're under pretty strict regulation. The oversight comes from the Department of Financial Protection and Innovation, the DFPI.
DFPI, okay.
Right. So these licensed escrow agents have to follow specific state laws, operational procedures. It adds this layer of state-level accountability, consumer protection, that you might not find in states where, say, title companies or lawyers handle closings without that specific escrow license.
So knowing your escrow holder is DFPI licensed is a key California point.
Definitely. It's an important detail for agents and consumers here.
Okay, so escrow, secure, regulated, neutral holding process, the bridge between the agreement and the actual ownership transfer. Let's walk across that bridge now, step by step. After the purchase agreement is signed, what's the very first thing that happens to get escrow rolling?
It really is an orchestration, like you said. It kicks off with formally opening escrow. This usually happens pretty quickly after the offer is accepted and the agreement is signed by everyone. It's the official act of setting up that neutral third-party account just for this one deal.
how does that happen practically?
The signed purchase agreement gets delivered to the chosen escrow company. That's the trigger. That delivery officially initiates the process.
Kind of like setting up the mission control for the deal.
That's a good analogy, yeah.
Yeah.
And mission control needs its flight plan, right? They need detailed instructions. These are the escrow instructions. They spell out exactly how the escrow agent needs to handle the money, the documents, all the conditions, based strictly on what the buyer and seller agreed to in the purchase agreement.
So they don't just guess.
Oh, definitely not. Your sources really stress this. The purchase agreement and the escrow instructions, they work together. They're both legally binding contracts about real estate interests, and they have to be in writing. Think of the purchase agreement as the what's being sold, for how much, under what terms. The escrow instructions are the how for the escrow holder, how to actually execute those terms to get the deal closed. They clarify who does what, by when, during the escrow period itself.
Got it. Purchase agreement is the blueprint. Escrow instructions are the construction manual for the escrow holder. Okay, instructions are in. What comes next?
That launches arguably one of the most critical phases, the period of investigations and due diligence. This is mostly driven by the buyer, although the seller has obligations too, like providing disclosures. This time frame is usually defined by the buyer's investigation contingency period, which is something negotiated right in the purchase agreement.
How long does that usually last?
It can vary. Your sources mention it could be as short as, say, 3 days in a really fast market, or more commonly, maybe up to 17 days. But like most things in the contract, it's negotiable. Could be longer, could be shorter.
And this is the buyer's big chance to really kick the tires, metaphorically speaking.
Exactly, to make sure they understand exactly what they're buying. This is when the key inspections usually happen. Home inspections are really vital. You get a professional inspector to go through the property with a fine-tooth comb. They check everything: structure, roof, plumbing, electrical, heating, cooling systems. Their report gives the buyer a detailed picture of the home's condition, potential issues, maybe future repair costs.
And the appraisal happens around this time, too.
Yes, the appraisal is another huge piece, especially if the buyer's getting a loan. A licensed appraiser gives an independent professional opinion of the property's fair market value. They look at the property itself, condition, size, features, location, and compare it to similar properties that have sold recently nearby. This appraisal report is essential for the lender.
Why is it so important for the lender?
Because the lender will typically only loan a certain percentage, the loan-to-value ratio, based on the appraised value or the purchase price, whichever one is lower. The appraisal basically confirms the property is adequate collateral for the loan. It protects the lender.
Okay, makes sense. Now, what if something major pops up? Say, the inspection finds a big roof leak or foundation cracks. Or what if the appraisal comes in way under the agreed-upon price?
Ah, yes. This is where an agent really earns their stripes. Negotiation skills become absolutely key here. If inspections uncover significant problems, or if that appraisal comes in low, creating a gap between the price and the perceived value, the parties have to address it. They can't just ignore it.
So what are the options usually?
Typically, you might see the buyer ask the seller to make specific repairs before closing. Or maybe the seller offers the buyer a credit at closing, basically, discount the price a bit so the buyer can handle the repairs after they own it. If it's a low appraisal issue, the most common approach is to try and renegotiate the purchase price down to, or closer to, the appraised value.
What if they just can't agree? The seller won't do repairs or won't lower the price, and the buyer isn't comfortable moving forward.
This is where contingencies are crucial. If the buyer is still within their agreed-upon inspection or appraisal contingency period, and they've followed the contract's rules for notification, they generally have the right to cancel the contract.
And they get their deposit back?
Usually, yes. If they exercise the contingency properly, they should get their earnest money deposit back. They would, however, likely be out the money they spent on the inspection and the appraisal itself. Those costs are typically non-refundable.
So it's a critical decision point. Agents need to guide clients carefully through those options and deadlines.
Absolutely. And don't forget, the lender might have their own requirements based on the appraisal or the loan type. They might insist on certain repairs being done before they'll fund the loan, which can add another layer of complexity and timing pressure.
Right. Speaking of lenders, financing, that's obviously a massive part of this whole escrow equation. How does the loan process mesh with everything else happening in escrow?
Oh, it's woven right through the whole thing. Getting the financing sorted smoothly is absolutely key to closing on time, or closing at all. And really, the groundwork should start even before the buyer finds a house. Getting pre-approved for a mortgage is fundamental.
Why is pre-approval so important?
It gives the buyer a realistic idea of how much they can actually borrow. It strengthens their offer when they make one, and crucially, it helps avoid nasty surprises later, like finding out mid-escrow that they don't actually qualify for the loan they need. Loan denial is a common reason deals fall apart, and pre-approval helps reduce that risk significantly.
Okay, so buyer's pre-approved, finds a house, gets the offer accepted. Now they move forward with full loan application. What info do they need to provide for that?
The lender needs specific, verifiable details to formally approve the loan. Your sources list the key items: the buyer's full legal name, their income information, pay stubs, tax returns, that sort of thing, their social security number, which is needed to pull credit reports and verify identity. They also need the property address, or at least its location if the address isn't set yet. The property value, which for a purchase is the sale price and, of course, the exact loan amount the buyer is requesting.
And providing this information triggers some important consumer protection rules, right? This is where TRI-D comes in.
Exactly. Now we enter the realm of federal mortgage disclosures, heavily regulated by the Consumer Financial Protection Bureau, the CFPB. And yes, TRI-D is the big one here. TRI-D stands for the TILA-RESPA Integrated Disclosure Rule.
TRI-D, definitely a need-to-know acronym for anyone in real estate. What's the backstory? Why was it created?
So TRI basically combined and simplified two older federal laws.
Yeah.
The Truth in Lending Act, or TILA, and the Real Estate Settlement Procedures Act, RESPA. Before TRIDE, borrowers got hit with a bunch of different disclosure forms, sometimes overlapping, often confusing. TRIDE aimed to streamline all that, create standardized forms that are easier for consumers to understand. The whole goal is transparency, helping borrowers clearly see the key features, the costs, the risks of their mortgage before they commit, so they can shop around and make informed choices.
Makes sense. And the first big form under TRI that the buyer receives is the loan estimate, the LE.
That's right, the loan estimate, or LE. It's the initial snapshot of the loan terms and estimated costs. And there's a strict deadline. The lender must give this LE form to the buyer no later than 3 business days after receiving that complete loan application we just talked about.
3 business days. Okay. And what should an agent be pointing out to their client on this LE? It looks pretty detailed.
It is detailed, and agents aren't loan officers, so you don't need to explain every single line. But understanding the main sections is crucial for guiding your client. First, the loan terms section right up front. That shows the loan amount, the interest rate is it fixed, adjustable. The loan product, like conventional, FHA, VA, and the loan type, usually purchase. This needs to match what the buyer thinks they're getting.
Okay, basic loan details. What else?
Then there's the projected payment section. This estimates the total monthly housing payment. It breaks it down into principal and interest, any expected mortgage insurance premiums, and an estimate for the escrow payment, that's the money the lender collects each month to pay the borrower's property taxes and homeowner's insurance later. Gives a good idea of the ongoing monthly cost.
And the part that often causes confusion, the closing costs.
Yes, the costs at closing session. This is a big one. It itemizes all the estimated fees and charges to get the loan and close the deal. It's broken into 2 main buckets: loan costs and other costs. Loan costs are fees directly related to the lender and the loan itself. Your sources show these are further broken down. Origination charges, that's what the lender or broker charges for making the loan, like application fees, underwriting fees. Then, services borrower did not shop, for these are third-party services the lender requires, and they choose the provider. Think appraisal fees, credit report fees, and then importantly, services borrower did shop for. These are services the lender requires, but the buyer can choose their own provider, usually from a list the lender gives them. This often includes things like title services, maybe pest inspections.
So that services borrower did shop for category. That's an area where the buyer might actually be able to save some money by comparing providers.
Exactly. That's a key takeaway for the agent to highlight. Hey, look at this section. You might have some choices here. Then you have the other costs category. These are costs tied to the transaction, but not necessarily direct lender fees. Big ones here include taxes and other government fees. Think of recording fees to the county, state, or local transfer taxes, which can be significant in California.
Right, those transfer taxes.
Definitely. Also, prepaids. These are items you pay at closing that actually cover time after closing. Things like prepaid interest for the rest of the closing month, the first full year's homeowner's insurance premium, maybe a few months of property taxes up front, and finally, the initial escrow payment at closing. This is the seed money needed to start that escrow impound account with the lender so they have enough funds to pay the first property tax and insurance bills when they come due.
Wow, okay. That LE really packs in a lot of estimated financial detail up front. Reviewing it closely seems essential.
Absolutely non-negotiable. And there's more. The LE also have a comparison section. Helps the buyer see estimated costs over 5 years. The APR, annual percentage rate, the TIP-P, total interest percentage. These give a broader view of the loan's true cost. Plus an other considerations section mentioning things like loan assumption rules, late payment fees, and whether the lender intends to service the loan themselves or sell the servicing rights.
If the buyer looks at this LE and has questions, or something doesn't look right compared to what they discussed with the lender, who should they talk to?
The LE itself provides that info clearly. It lists contact details for the lender, any mortgage broker involved, and their specific loan officers' names, license numbers, email, phone. That individual loan officer listed should be the buyer's primary point of contact for questions about the LE. Agents should absolutely encourage clients. Compare this LE carefully to your initial conversations, and if anything seems off, call that loan officer right away. Don't wait.
Okay, good advice. So, stepping back to the overall escrow timeline, the loan is processing, the LE is out. What else is happening concurrently during this period before we get near the end?
Another really crucial piece is the title search and getting title insurance. This usually happens relatively early in the escrow period. A title company dives into the public records related to the property. They trace its ownership history, looking for any potential problems or clouds on the title.
Clouds on the title? Like what?
Could be anything. Old mortgages that were never properly released, unpaid property tax liens, judgments against previous owners, unexpected easements giving someone else rights to use the property, even errors in how deeds were recorded years ago. Or worse, things like forgery or fraud in past transactions.
So it's basically a legal background check on the property itself, making sure the seller truly has the right to sell it free and clear.
That's a perfect way to describe it. And based on this search, the title company issues title insurance. This insurance protects against financial loss from title defects that maybe weren't found in the record search or from those hidden risks, like forgery. There's typically a policy to protect the buyer or the owner's policy, and one required by the lender to protect their interest, the lender's policy.
And the fees for this are on the LEA and closing documents.
Yes. Your sources point out that the title insurance fees cover the whole process. The title examination, preparing the title commitment, which is like a promise to ensure if certain conditions are met, working through any underwriting issues found, and finally issuing the actual insurance policies. An interesting detail is that the premium for the lender's title policy is shown on the LE in the final closing disclosure without any discount, even if the buyer buys an owner's policy at the same time, which often happens and usually results in a simultaneous issue discount. The forms keep it simple for disclosure purposes.
Okay, so inspections done, appraisal in, loan moving forward with the LE reviewed, title search complete, and insurance being arranged. What needs to happen to get us to the actual closing table?
The big thing is fulfilling all the conditions and contingencies laid out in the purchase agreement. Every single requirement has to be met and signed off on. This means the buyer needs final, formal loan approval, not just pre-approval. They need to have approved the inspection reports, the title report. The seller needs to have completed any repairs they agreed to do, provided all required disclosures. Any other specific conditions unique to that deal have to be satisfied.
And the escrow holder is tracking all of this.
Yes, that's a key part of their job. They monitor progress and verify that each condition has been met according to the instructions before they can move to the final step.
And once all those boxes are ticked, they get the final major loan document, right? We get closing disclosure.
The closing disclosure, or CD, yes. This is the second key document under TRID, the grand finale, really. Lenders have to get this CD form to the buyer at least 3 full business days before consummation. Consummation is just the technical term for when the buyer becomes contractually obligated on the loan, which is typically the closing or signing day.
And the CD contains everything, all the final numbers.
Pretty much. It provides the definitive, detailed breakdown of all the costs associated with the transaction. For the buyer, it shows their final numbers, and it also includes summary information about the seller side of the transaction, showing who paid what for shared costs. It's a final financial accounting.
How closely does it match the loan estimate the buyer got earlier?
It's designed to look very similar. The layout, the categories, loan costs, other costs, projected payments, loan calculations, they generally mirror the LE. But the key difference is the CD shows the final, actual numbers based on the services used at agreements reached during escrow. So you'll see the final loan amount, interest rate, APR, the final figures for all those closing costs, the total interest percentage, TIP, the total finance charge. It's the finalized version of what the LE estimated.
Is there anything new on the CD that wasn't really broken out on the LE?
Yeah, sometimes there's a bit more granularity. For example, one source mentioned that while loan originator compensation is baked into the origination charges on the LE, the CD might show that specific component more clearly within those charges. It reflects the final settled figures.
And crucially, the CD tells the buyer exactly how much money they need to bring to the closing table.
Exactly. There's a very important section, usually on page 3, called Calculating Cash to Close. It clearly adds up everything the borrower is obligated to pay at closing, then subtracts any credits they're receiving, like their earnest money deposit, any seller credits for repairs or closing costs. The bottom line number is the final amount the buyer needs to have ready, typically via cashier's check or wire transfer to the escrow holder to close the deal.
Does the CD also list all the parties involved, like the LE did?
Yes, and usually even more comprehensively. The CD typically includes contact information for the borrower, the seller, the lender, any mortgage broker, both real estate brokers, buyers and sellers, and the settlement agent, which in California is usually your escrow holder. Makes it easy to see who's who in the final stages.
Okay, so the buyer gets this detailed CD at least 3 business days before closing. What's the absolute top priority during that waiting period?
Review, review, review. That 3-day waiting period exists specifically so the consumer has time to digest this final information without pressure. The absolute priority is to compare the CD line by line against the most recent loan estimate they received. Check everything. Do the loan terms match? Are the closing costs as expected? Are the credits correct? This is the critical window to spot any errors, misunderstandings, or unexpected changes and get them resolved before signing the final loan documents. Ask questions immediately if anything looks different or confusing. Don't wait until you're sitting at the signing table.
Good advice. Now, what if something does change after the CD goes out but before the actual closing happens? Does that always mean the clock resets and there's another 3-day delay?
Not necessarily. This is a common point of confusion. The rules are quite specific about what triggers a new mandatory 3-business-day waiting period. According to the CFPB, only 3 specific changes, if they happen before consummation, will reset that clock. 1. If the APR, the annual percentage rate, increases beyond a certain legal tolerance, making the previous disclosure inaccurate. 2. If a prepayment penalty is added to the loan, something the buyer wasn't expecting. And 3, if the basic loan product itself changes, for example, switching from a fixed-rate loan to an adjustable-rate loan, or vice versa.
Okay, so only those 3 major changes automatically trigger a new 3-day wait. What about other, maybe smaller changes?
If other things change before consummation, maybe a fee changes slightly, or who pays a certain recording tax gets adjusted, the lender generally just needs to provide an updated, corrected CD reflecting the change by the time of consummation. It doesn't automatically delay the closing. And your sources even mentioned something interesting. Corrections can happen even after closing. If something occurs within 30 days after closing that makes the CD inaccurate regarding money the consumer paid, the lender has to issue another corrected CD within 30 days of finding out about it. The push for accuracy is strong.
Wow, okay. So almost there. CD reviewed, funds ready. Is there one last check the buyer should do before signing everything?
Yes, absolutely. Highly recommended. The final walkthrough. This usually happens maybe 24 or 48 hours before the scheduled closing appointment. It's the buyer's last chance to physically inspect the property.
What are they looking for?
They're verifying that the property is in the condition they agreed upon in the contract, that any repairs the seller promised to make have actually been completed properly, that all the appliances and fixtures that were supposed to be included are still there, and importantly, that no new damage happened while the seller was moving out. It's the final confirmation before taking ownership.
Makes sense. Catch any last-minute issues. Okay, conditions met, CD reviewed, walkthrough done, funds are ready. Then comes the actual closing.
Yes, closing, or consummation as the lenders call it. This is the finish line. All parties sign the necessary documents. The buyer signs the loan documents, the note, the deed of trust. The seller signs the deed transferring ownership. The buyer's funds, the down payment, the closing costs calculated on the CD are confirmed as received by the escrow holder. The lender wires the loan funds into escrow. Then, The escrow holder does the final accounting and disperses all the money, pays off the seller's existing mortgage if there is one, pays the seller their proceeds, pays the real estate agent commissions, pays the title company, pays recording fees, etc. Ownership legally transfers when the new deed is officially recorded with the county. And then finally,
Keys.
keys. That's usually the moment it feels real for the buyer. Typically, keys are handed over right after confirmation that the deed has been recorded.
Ah, the payoff moment. Now let's circle back to those closing costs shown on the CD. We know they're more than just the down payment. How much more are we talking?
Significantly more, usually. And it's important for buyers to budget for this. Both buyers and sellers have closing costs, but yeah, the buyer typically pays the larger share. These costs cover all those services needed to make the transaction happen. The loan processing, the appraisal, title search, insurance, escrow services, recording fees, and so on. Your sources give a general range buyer. Closing costs often fall somewhere between 3% and 6% of the loan amount.
3 to 6%. So on a, say, $500,000 loan, that could be $15,000 to $30,000 on top of the down payment.
Potentially, yes. It really adds up. Now, for our CA corner, what's a typical number look like here?
Right. California-specific numbers. One source estimated average closing costs in California were around $7,953, and that includes transfer taxes. If you pull out those potentially hefty transfer taxes, the average was closer to $5,665.
Good context. But remember, those are just averages. The actual costs will vary a lot based on the specific loan amount, the property's location, because transfer taxes differ by city and county and which service providers are used for things like title and escrow.
Besides the loan origination fees, appraisal, title insurance that we talked about earlier, what other common costs would a buyer see itemized on their final CD?
Looking at the typical CD breakdown, you'll often see things like the escrow fee itself, the county recording fees for the deed, and mortgage documents. Sometimes buyers pay discount points. That's an upfront fee to get a lower interest rate. We mentioned prepaid interest covering the interest from closing day through the end of that month. The first full year's homeowner's insurance premium is often paid at closing, and that initial deposit to fund the escrow impound account for future taxes and insurance. Oh, and for certain loans, like VA loans, there might be a specific VA funding fee included in the costs.
You mentioned property taxes and prepaid interest being tied to the closing date. How exactly are those amounts calculated? That seems like it could get tricky.
It involves something called prorations. It sounds complex, but the concept is fair. Items that cover a specific period of time, like property taxes, which in California are often paid twice a year, or maybe homeowner association dues paid monthly or quarterly, have to be split fairly between the buyer and seller based on who owns the property during that period.
So, based on the exact closing date.
Exactly. The escrow holder calculates how many days the seller owned the property in that payment cycle and how many days the buyer will own it. If the seller already paid the taxes for a period that extends beyond the closing date, the buyer essentially reimburses the seller for the days the buyer will own the home during that prepaid period. That would be a charge to the buyer and a credit to the seller on the CD. Conversely, if taxes are due but haven't been paid yet, the seller might give the buyer a credit for the seller's portion of the tax bill up to the closing date, and the buyer will then be responsible for paying the whole bill when it comes due. Prepaid interest is similar. It just covers the interest on the new loan from the closing date until the first of the following month. Your sources mention the precision needed here. These daily amounts are usually calculated carefully, often down to the penny.
Okay, so prorations ensure everyone pays their exact share for the time they own the property. Got it. What about sellers helping buyers out? Can a seller contribute towards some of these closing costs?
Yes, definitely. This is a really common negotiation point, particularly in certain market conditions, maybe a buyer's market. Sellers can agree to pay a portion, or sometimes even all, of the buyer's closing costs. This is usually structured as a credit to the buyer on the closing disclosure, reducing the amount of cash the buyer needs to bring. These are called seller concessions or seller contributions.
That sounds like a huge help for buyers, especially if they're tight on cash after the down payment.
It absolutely can be. It can make the difference in whether a buyer can afford to close on a particular home.
Are there any rules about how much a seller can contribute? Can they just pay everything?
No, there are definite limits, and this is a really key piece of knowledge for agents to have. These limits aren't arbitrary. They're set by the type of loan the buyer is getting. Conventional, FHA, VA, jumbo loans all have different rules. They also depend on whether the property is a primary residence, a second home, or an investment property. And often how much the buyer is putting down matters too.
Wow, okay. Can you give an example?
Sure. For a conventional loan on a primary home, if the buyer's down payment is less than 10%, The seller can typically only contribute up to 3% of the sale price, or appraised value, whichever is less, towards closing costs. But if that same buyer puts down, say, 25% or more, the seller can contribute up to 9%. Big difference.
And FHA or VA loans.
FHA loans generally allow seller contributions up to 6% of the price or value. VA loans are even more generous. The seller can pay all of the buyer's loan-related closing costs, plus up to 4% of the loan amount towards other things like prepaid taxes, insurance, or even paying off the buyer's debts.
Those are very specific rules. Why do these limits exist? Is it just arbitrary?
Your sources indicate it's largely about preventing fraud and managing risk for the lender. Without limits, a buyer and seller could theoretically agree to inflate the purchase price way above market value and then have the seller concede that extra amount back to the buyer to cover all costs, effectively financing the buyer's closing costs into a loan amount that doesn't reflect the property's true value. The limits help keep the transaction grounded in the property's actual worth.
Okay, that makes sense. So lots of moving parts, lots of financial details to keep track of. Given all this complexity, what are some of the most common snags or challenges that can pop up during escrow and potentially threaten the deal?
Oh, there are definitely potential pitfalls. Financing problems are probably at the top of the list. You might see a buyer get denied for the loan late in the game. Maybe something changed in their credit or income, or maybe the initial pre-approval wasn't as solid as they thought. We already talked about appraisal discrepancies, the value coming in lower than the price. That's a frequent hurdle requiring renegotiation or more cash from the buyer. And sometimes the lender just throws in last-minute conditions or requests for more documents during final underwriting. And if the buyer isn't super quick to respond, it can cause major delays.
So what's the best way to avoid those financing headaches?
Preparation and communication are key. Having that strong pre-approval before even making an offer is huge. Working with a really experienced communicative mortgage professional makes a big difference. And the buyer absolutely needs to be ready to provide any requested documents immediately. Procrastination can kill deals at this stage.
We also saw in the source materials, like that Reddit discussion, people getting really frustrated about big differences between the initial loan estimate and the final closing disclosure. That seems like a major pain point.
It absolutely is. And it touches on really important issues of transparency and agent responsibility. That discussion highlighted cases where the final cash-to-close number on the CD was thousands of dollars higher than what was shown on the LE. Imagine budgeting based on the LE and then suddenly needing to come up with an extra, say, $5,000 right before closing. It can be devastating.
What were the reasons people suspected for those big jumps?
Well, sometimes there were legitimate reasons. Maybe final underwriting turned up something that changed a fee, or the actual costs for prepaid taxes or insurance ended up being higher once the closing date was finalized. Those things can shift slightly, but the discussion also raised ethical concerns. Some people felt certain lenders might intentionally provide a very low, maybe even unrealistic, LE up front, sort of a bait and switch to get the borrower hooked.
The thinking being, by the time the higher CD comes out 3 days before closing, the buyer is so far down the road, emotionally and financially invested, that they'll just scramble to find the extra money rather than walk away.
Exactly. That was the concern raised, hoping the time pressure forces the buyer to accept the higher costs.
That feels ethically problematic. How should agents handle situations where there's a big LE to CD gap?
It really underscores why accurate estimates from the lender are crucial from the start, and why the agent needs to help set realistic expectations with the client about potential costs. Minor variations between LE and CD are normal. But if there's a significant unexplained jump, the agent, working with her client, should be questioning that lender aggressively during that 3-day CD review period. Why did this fee increase? Where did this charge come from? It's about protecting the client and ensuring they aren't blindsided financially at the last minute. This fits right into our Ethical Compass segment. Maintaining trust is paramount.
Okay, good point. Beyond financing issues and cost discrepancies, what other kinds of disputes can arise and land in escrow?
Oh yeah, disputes between the buyer and seller themselves can definitely happen during escrow. Your sources suggested it's not that rare. Maybe almost a third of deals hit some kind of snag or disagreement. For instance, maybe the buyer wants to cancel based on the inspection contingency, but the seller disagrees and claims the buyer didn't follow the rules or the issue isn't significant enough.
So what happens then? Who decides?
When the escrow agent receives conflicting instructions, say, the buyer demands their deposit back, and the seller demands it be released to them, the escrow agent generally has to freeze the funds. They can't release the money to either party until the dispute is resolved. They get stuck in the middle.
So the money just sits there. How do the buyer and seller typically work it out? Is there a process?
Yes, there's usually a structured process, often outlined in the purchase agreement itself. Your sources describe a common three-tiered approach. Tier 1 is negotiation. Usually they have a set period, maybe 30 to 60 days, for the buyer and seller, often with their agent's help, to try and negotiate a resolution directly. The escrow agent might facilitate by exchanging documents between them. If negotiation fails, it typically moves to Tier 2, mediation. This might take another 60–90 days. A neutral third-party mediator comes in to help the parties talk and find common ground. Mediation is usually non-binding, meaning the mediator suggests solutions but can't force an agreement. Still, it's often successful. If mediation still doesn't resolve it, the final step is usually Tier 3, arbitration. This is more formal, like a mini-trial. An arbitrator hears evidence from both sides and makes a binding decision. Both parties have to accept the outcome. It's generally faster and less expensive than going to court.
Okay, a structured path for disagreements. That makes sense. But your sources also flagged a much more alarming challenge: outright fraud and scams, particularly targeting California real estate deals.
Yes, this is a huge area of concern and something every agent in California needs to be hyper-aware of. The DFPI bulletin you mentioned was stark. It highlighted a serious and growing risk of sophisticated scams aimed directly at escrow companies, title companies, agents, buyers, sellers, basically everyone involved.
Right.
And these aren't just warnings. Real companies are suffering major financial losses, sometimes even ending up in regulatory takeover.
What kind of scams are we talking about? How do they work?
They mostly rely on what's called social engineering. That means manipulating people psychologically, exploiting trust or urgency to trick them into doing something they shouldn't, like sending money to the wrong place or giving up sensitive information. Common tactics include phishing emails, fake emails designed to look legitimate, maybe like they're from the bank or escrow company, trying to get you to click a bad link or enter your password. Business email compromise, or BEC, is another big one. That's where criminals hack into someone's email account, maybe the agents or the escrow officers, and then monitor the transaction. At the right moment, they send an email from that compromised account, impersonating the real person with fraudulent instructions. Or they might just impersonate someone via phone or a slightly altered email address, pretending to be the escrow officer, the agent, maybe even the buyer or seller, creating a sense of urgency to get money moved quickly.
That DFPI bulletin had a scary example from 2023. Can you recap that? It really shows the potential damage.
Yeah, that one was chilling. An escrow company got a phone call from someone claiming to be from their bank's IT support. They told the escrow officer to log into the company's online trust account for some supposed data migration. Right after that call, the escrow company's internet went down briefly. When it came back up, they discovered multiple wire transfers had been initiated out of their trust account and their general operating account. Nearly $2 million was diverted to criminals. The company couldn't recover the money or cover that massive shortage in their client trust funds. The DFPI had to step in and take over the company as conservator to protect the consumers whose funds were gone. It was catastrophic for that business.
Wow. And what about the more common wire fraud scams targeting buyers?
Those are incredibly prevalent. The classic scenario: a scammer hacks into email threads related to the transaction. They watch the conversation. Then, just before closing, they send the buyer an email that looks like it's from the escrow company or the agent. This email will say something like, urgent, updated wiring instructions, or final closing fund instructions. The instructions, of course, lead to the criminal's bank account, not the legitimate escrow account.
And if the buyer doesn't double-check?
If the buyer doesn't independently verify those instructions using a trusted method, like calling a known verified phone number for the escrow officer, not hitting reply, or using contact info from the suspicious email, they could end up wiring their entire down payment and closing funds directly to the fraudsters. It happens all the time, and getting that money back is extremely difficult, often impossible.
This sounds like something agents need to be constantly warning their clients about. What practical steps can professionals take to guard against these scams?
The DFPI bulletin laid out clear recommendations aimed at escrow companies, but highly relevant for agents too. First, basic cyber hygiene. Strong passwords, secure systems, being wary of suspicious links or attachments. Second, immediate reporting. If a scam is suspected, or worse, if funds go missing, report it instantly to the DFPI, to law enforcement. The FBI's Internet Crime Complaints Center, IC3, is the main portal for this. Third, and maybe most important, is training and awareness. Everyone involved in transactions needs ongoing training about these social engineering tactics. Cultivate a healthy skepticism, especially for any unexpected requests involving money movement or changes to instructions.
What about verifying those wire instructions specifically? That seems like the highest risk point.
Absolutely critical. Strict procedures are essential. Some companies might require amended instructions to be notarized. But the gold standard, the thing everyone should do every single time, is verbal verification. Before sending any funds, the buyer, or whoever is sending money, must call the intended recipient, usually the escrow officer, using a known, independently verified phone number 1 obtained at the beginning of the transaction, not from the email containing the instructions, and verbally confirm the account number and routing details.
So just having a warning disclaimer in your email signature isn't enough.
It helps raise awareness, but no, it's definitely not enough on its own. It has to be backed up by rigorous, consistent verification protocols. No exceptions.
These threats really drive home the agent's duty to protect their client. It ties right back into that ethical compass idea, doesn't it? Especially during these final high-stakes stages.
It absolutely does. And speaking of ethics, your sources highlight another critical boundary agents must respect during closing. Don't practice law or give tax advice. A prime example is advising clients on how to take title to the property, like should they choose joint tenancy, tenants in common, community property. These choices have significant legal and tax consequences down the road.
So what should an agent do?
Agents must advise their clients to seek advice from qualified professionals, an attorney for legal implications, a CPA, or tax advisor for tax implications. Giving that kind of advice yourself is unethical, outside the scope of your license, and opens you up to serious liability.
So the agent's role is to guide them through the process of closing, but know exactly when to point them towards other experts for specific legal or financial advice.
Precisely. And really, mastering everything we've discussed today, understanding the escrow steps, knowing the LE and CD inside and out, being able to explain closing costs and prorations, and especially being aware of the pitfalls like disputes and fraud. That's what empowers an agent to guide clients effectively and ethically. Reviewing those closing documents with the client isn't just ticking a box, it's fulfilling an ethical duty to help them understand what they're signing and to be a second pair of eyes spotting potential errors or red flags.
And being that vigilant guard against scams, that's not just good business, it's a core ethical responsibility to protect your client's money and trust.
You got it. It demands ongoing awareness and a proactive defense mindset.
It really sounds like navigating this precision landing successfully is less about just shuffling papers and more about being that knowledgeable, trustworthy pilot who actively protects the passengers through the most critical phase of the journey.
Well said. And this directly connects to our Adapt and Connect theme, too. When you truly master the complexities of escrow and closing, you gain the ability to adapt confidently when challenges inevitably arise. Whether it's dealing with a low appraisal, finding a solution for a repair issue, handling a sudden lender demand, or crucially, recognizing and stopping a fraud attempt, that knowledge lets you navigate turbulence smoothly.
And how does that build connection with the client?
Think about it. When you can transparently walk your client through those confusing disclosures like the LE and CD, when you can clearly explain where their money is going in closing costs, when you proactively warn them about risks like wire fraud and tell them how to protect themselves, you build incredible trust. It reduces their anxiety, empowers them because they understand the process, and solidifies your relationship. It helps ensure closing day feels like a success, a moment of harmony, not stress and confusion.
Okay, let's try to make this even more concrete with our think like an agent scenarios. Ready for the first one?
Let's do it.
All right. Scenario 1. You get an email. It looks like it's from the escrow officer you've been working with, but the tone feels a bit off, kind of urgent. It provides new wiring instructions for your buyer's closing funds, saying there was a last-minute bank issue. Based on everything we just discussed about scams, what are your immediate steps?
Okay, red flags waving everywhere. Urgency, changed instructions via email, classic scam indicators. Step 1, do not trust those instructions. Do not forward that email to the buyer. Do not reply to it. Step 2, immediate verification through a separate, trusted channel. I need to pick up the phone and call the escrow officer directly using the phone number I already have for them from the start of the transaction, a number I know is legitimate, not one listed in that suspicious email. I'll ask them point blank, did you just send out new wiring instructions? There seems to be some confusion. I would read the account details from the suspicious email to them over the phone so they can confirm if they are valid or fraudulent.
Excellent. Verify using known contact info. What about your buyer? They're the ones potentially sending the money.
Absolutely. My ethical duty is to protect them. I need to contact my buyer immediately again using a phone number I know is good and warn them. I'd say something like, I received a suspicious email that looked like it had wiring instructions. Do not, under any circumstances, wire funds based on instructions received solely via email. Always call me or call the escrow officer directly at I provide known good number to verbally confirm any instructions before sending money. If we confirm the email was fraudulent, or even if we just can't immediately disprove it, I need to escalate. Report it to my broker, make sure the actual escrow company is aware of the attempt, and strongly advise the client to report it to their bank and the FBI's IC3. Better safe than sorry doesn't even begin to cover it here.
Perfect. Proactive defense and education are key. Okay, scenario 2. Your buyer's appraisal comes back, and it's $20,000 lower than the agreed-upon purchase price. The lender calls the buyer and says, because of the low appraisal, we have to reduce your loan amount. You'll need to bring an extra $20,000 in cash to closing. Your buyer tells you they absolutely don't have that extra cash. How do you advise them and navigate the next steps in escrow?
Okay, this is a very common scenario, the appraisal contingency crunch. First thing is to calmly explain the situation clearly to my buyer. Help them understand why this happened. The lender bases the loan on the lower of the price or appraised value. Since the value came in low, the loan amount gets reduced, creating that $20,000 gap they'd need to cover to stick to the original price. Next, we pull out the purchase agreement and look closely at the appraisal contingency addendum, assuming they have one and we're still within the contingency period.
They have options, right?
Yes. Option 1 is negotiation. We can go back to the seller, provide them with a copy of the appraisal report, usually required, and formally request a price reduction. Maybe ask for the full $20,000 off. Maybe negotiate a smaller reduction that the buyer could potentially cover. If a seller agrees to lower the price, fantastic. We draft an addendum to the purchase agreement reflecting the new price, get it signed by everyone, submit it to the lender, and hopefully proceed to closing, assuming the lender approves the change.
But what if the seller says no? They won't lower the price at all.
If the seller won't negotiate, and the buyer truly cannot or will not bring that extra $20,000 to closing, then their safety net is that appraisal contingency. Assuming they're within their rights per the contract timeline, they can choose to exercise the contingency and cancel the transaction. My job then is to guide them through the proper procedure for delivering the written notice of cancellation to the seller and the escrow holder. If done correctly according to the contract, this should allow the buyer to get their earnest money deposit back, although they'll still be out the cost of the appraisal and any inspections they paid for. My role is to lay out the choices, clearly negotiate or cancel based on the contract terms and their financial situation, and then help them execute their chosen path professionally.
Great examples. They really show how understanding the process and the contract allows agents to guide clients through tough spots.
Okay, let's try to pull this all together. What are the absolute key takeaways from this deep dive on California escrow and closing? All right, the essentials. First, escrow is that vital, neutral safeguard. In California, it's often handled by independent DFPI licensed agents, protecting everyone by holding funds and documents until all contract conditions are met.
Second, the process itself. It's a step-by-step orchestration. Opening escrow, crucial investigations like inspections and appraisals, navigating the financing maze guided by TRI-D.
Clearing title, getting title insurance, making sure every single condition is fulfilled, doing the final walkthrough, and finally reaching the closing table.
Third, those TRI-D disclosures are critical for transparency. The loan estimate, LE, early on gives the estimate, and the closing disclosure, CD, at least 3 days before closing gives the final numbers. That 3-day review period for the CD, absolutely essential for the buyer to compare it to the LE and catch any issues before signing.
Fourth, closing costs are real and significant, often 3–6% of the loan amount for buyers in California, plus transfer taxes. Things like property taxes get precisely divided through prorations based on the closing date. And while sellers can help with costs via concessions, there are strict limits based on loan type and down payment, partly to prevent fraud.
And finally, be prepared for challenges. Financing hurdles, potential disputes that can freeze funds, unexpected delays, and critically, the pervasive threat of wire fraud and social engineering scams. Vigilance, training, and ironclad verification procedures, especially for wire instructions, are non-negotiable defenses.
Absolutely. And weaving through all of this is the agent's role, to be the knowledgeable, ethical guide, providing clarity, paying meticulous attention to detail, protecting the client's interest, and ultimately bringing confidence and calm to what can be a very stressful final stage of buying or selling a home.
Being that steady hand ensuring the precision landing we talked about at the start.
Exactly. It's about bringing it all home smoothly and safely.
We've definitely covered a lot of ground today, from defining escrow to mapping the process, breaking down the costs, and facing the risks. This knowledge isn't just for passing an exam, it's the bedrock of a competent, ethical real estate practice in California. We really hope this deep dive has helped clarify the complexities of escrow and closing and given you more confidence to navigate it for yourself or your future clients.
For your next steps, maybe go back through your notes, really map out those escrow steps. Familiarize yourself with the key sections, the LE and CD. What should you be looking for? Try explaining prorations out loud simply. And please, please internalize the need for fraud vigilance. Make verbal verification your absolute habit.
That brings us to the end of this deep dive. Thanks so much for joining us. Remember to subscribe if you haven't already, and feel free to share this with others on their California real estate journey.
Join us next time on the Deep Dive as we continue the Golden State Real Estate Quest. We'll be tackling another foundational topic, understanding agency relationships and fiduciary duties in California.
Until then, keep studying, keep applying what you learn with integrity, and stay alert out there.
And as you move forward, here's something to think about. In a world where digital threats are constantly evolving and financial transactions are increasingly complex, how will you, personally, guarantee the security and uphold the immense trust your clients place in you during these final critical steps of their real estate transaction?